Imagine this for a second. What if I told you that a company in Pakistan, a tech firm in Japan, a manufacturer in Brazil, a factory in Germany, and a mining operation in South Africa could all prepare their financial statements using exactly the same accounting language? Literally, the exact same rulebook. Welcome back, everyone. Today we're diving into a fascinating explainer about an incredible story of global cooperation, a story that actually shapes the entire world economy, even though it usually operates completely behind the scenes. We're talking about International Financial Reporting Standards, or IFRS. Now, I know what you might be thinking. IFRS sounds like a dry technical alphabet soup. But stick with me here, because as you'll see in this explainer, this system is actually the absolute essential wiring of global trade and investment. It's the invisible bridge connecting economies worldwide.
Let's put this into perspective. Imagine trying to compare Apple's financial health with Toyota's. You're an investor, right? You're trying to figure out where to put your hard-earned money. Now, imagine trying to do that if every single country had completely different accounting rules. It would be total chaos, utter chaos, for regulators, for auditors, and for all these multinational companies. I mean, how do you even know what a company's revenue actually is if the very definition of revenue changes the exact second you cross a border? It would be like trying to build an international space station where every single country uses a completely different system of measurement. It just wouldn't work. So here's our roadmap for today's explainer. 1. The global language of finance. 2. A brief history of IFRS. 3. How IFRS actually works. 4. Who uses IFRS today? 5. The pros and cons. And finally, number 6, the future of financial reporting.
Okay, let's dive into this. Section 1, the global language of finance, chaos versus consistency. So what exactly is it? Well, IFRS stands for International Financial Reporting Standards. You can think of it as the Esperanto of finance, except, this one actually caught on. It's a globally accepted accounting framework designed by the International Accounting Standards Board, or ISB. The whole point of this system is to make financial statements consistent, transparent, and totally comparable no matter where a company is based. Now, you might be asking yourself, why should I care? Well, whether you're an everyday investor buying just a single stock, a student studying business, or a manager running a huge multinational company, this framework is what ensures you can actually trust the numbers right in front of you.
To really appreciate this, we've got to look at the before and after. The world before IFRS, man, it was a highly fragmented place. Every single country had its own domestic accounting rules. This caused massive investor confusion, for sure. And it made cross-border operations incredibly expensive because multinational companies basically had to keep multiple sets of books just to comply with all the different local laws. Plus, regulators really struggled to monitor global risks. But the world with IFRS, it gives us a unified language. It allows for seamless comparison, slashes those crazy administrative costs, and massively increases market trust across the board.
Moving on to Section 2, a brief history of IFRS, from concept to global standard. So how did we get here? Well, the push for a common standard actually started gaining some serious momentum way back in the 1960s, right as global trade was rapidly expanding. Then, in 1973, professional bodies from 10 different countries got together and formally created the International Accounting Standards Committee, the IASC, to start building common rules known as IAS. Fast forward to 2001, and the modern International Accounting Standards Board, the IASB, replaces the IASC and officially introduces the term IFRS. Then, a massive game-changer happens in 2005. The European Union mandates IFRS for the consolidated accounts of all their listed companies. That mandate gave global acceptance a colossal boost, and it really helped it grow into the dominant system we see today.
All right, let's look at Section 3, how IFRS actually works. The engine of standard setting.
Now, what's really interesting about this governance structure is how it's carefully designed to remain completely independent. At the very top, you have the IFRS Foundation. They're guided by a group of global trustees and a monitoring board of public authorities, and their job is to provide governance and secure funding without any political interference. Then, right under them, you have the IASB. They act as the independent body that actually writes the financial accounting rules. Next, there's the Interpretations Committee. They step in whenever there's confusion about how to apply a specific standard. Oh, and recently they added a new player, the ISSB, which focuses entirely on sustainability and climate reporting. The whole shebang works together as one tightly integrated system.
But how do they actually go about making a rule? It's honestly a lot like drafting a new law. First up, there's extensive research and consultation into a specific financial issue, which sometimes results in a preliminary discussion paper. Next, they release what's called an exposure draft. This is basically a proposed rule that the entire public, we're talking everyone from global banks to everyday investors like you and me, can actually debate and comment on. After tweaking it based on all that feedback, the final standard is voted on and officially issued. And they don't just stop there either. They conduct post-implementation reviews to make absolutely sure the standard is doing what it's supposed to do in the real world.
Which brings us to Section 4. Who uses IFRS today? A map of global adoption.
The global reach of this framework is truly expansive. I mean, from South Africa to Brazil, from Australia to the European Union, and in major hubs like the UAE and Pakistan, the adoption really spans across continents. More than 140 jurisdictions either require or permit IFRS for reporting financial health. It is, undeniably, the dominant financial framework on the planet right now. Usually, the decisions to adopt it are driven by a country's government, securities regulators, or professional accounting bodies.
To put that into perspective, 169 jurisdictions have been comprehensively profiled by the IFRS Foundation regarding their adoption status. Now, full disclosure, this doesn't mean every single one of those places uses it identically. There are a few different models out there. Some mandate full, completely unedited adoption. Others allow for partial adoption. And then some countries use a converged or modified model, like India with Ind AS, for example. That model aligns very closely with IFRS, but still keeps some specific local modifications tailored for their economy. Looking at the regional breakdown, it's pretty fascinating. Europe is fully on board. It's mandatory for all listed companies there. The Asia-Pacific region is a solid mix of full adoption and highly converged standards. But the Americas? They present a really interesting split. While Canada, Brazil, and Chile have fully adopted it, the United States remains a major holdout. The U.S. Securities and Exchange Commission still requires domestic companies to use U.S. GAAP. That's generally accepted accounting principles. Now, there were years of efforts to converge IFRS and U.S. GAAP, but that formal agenda has largely ended. So what does that mean? Well, it means the world essentially operates with two major accounting dialects today.
Now for Section 5, the pros and cons, a balanced ledger.
Let's look at how this builds a solid case for multinational businesses. There's a great quote that comes directly from a PwC survey of companies adopting IFRS. It simply says, cost saving, no dual accounting. Think about it. If you're operating in 20 different countries, you no longer need 20 different accounting departments translating financial statements into local rules. You prepare one single set of books. The administrative relief there is just massive.
And honestly, the advantages are incredibly strong across the board. First, you get global recognition, which automatically builds investor trust. You also get much better cross-border comparison. A student or an investor can sit at their laptop and easily compare the balance sheet of a listed company in Pakistan right alongside a major competitor in Germany. Plus, it's principle-based. That means it focuses on the underlying economic substance of a transaction rather than just forcing companies to follow rigid tick-the-box rules. This flexibility really enhances transparency and drives much better financial decision-making.
However, to keep our ledger balanced here, we do have to look at some of the criticisms. Remember that principle-based flexibility I just mentioned? Well, it requires a lot of complex, subjective judgment from accountants, which can sometimes lead to differences in interpretation. Also, implementing these standards is incredibly costly and burdensome. This is especially true for SMEs, small and medium enterprises, who simply don't have massive accounting departments to handle the workload. On top of that, there are persistent challenges with measuring assets at fair value. And of course, there's the ongoing headache for global companies that those U.S. GAAP differences still remain unresolved.
All right, moving into our final core section, Section 6, the future of financial reporting beyond the balance sheet.
Back in 2021, during the COP26 Climate Summit, the IFRS Foundation made a truly historic move. They announced the birth of the ISSB, the International Sustainability Standards Board. The global community finally realized something crucial. Tracking a company's environmental, social, and climate impact is now just as important as tracking its revenue. Investors absolutely want to know the long-term sustainability risks of the companies they are pouring money into, and the ISSB provides the exact framework needed to measure that impact.
Looking forward, we can see that IFRS is working hard to keep pace with a rapidly changing world. We're seeing a huge push into digital financial reporting through formats like XBRL, which makes data instantly readable by machines. We're also seeing the deep integration of ESG, environmental, social, and governance factors.
And as artificial intelligence begins to seriously shape how data is processed, having a globally connected, standardized language is going to be more vital than ever before for making smart, automated investment decisions.
So the crucial point is this. IFRS is far more than just a boring set of rules for accountants. It truly is the Esperanto of finance. It stepped in to replace global reporting chaos with reliable consistency and transparency. It's carefully governed by the independent IFRS Foundation, and it is actively evolving right now to encompass the digital and sustainable future of the global economy. Ultimately, it's the framework that allows global trust to even exist in the first place.
Which leaves us with a pretty fascinating thought to ponder. As global business becomes increasingly digital, green, and completely borderless, will the holdouts eventually join in? Will the entire world, without exception, eventually speak just one financial language? It's a massive question for the future of the global economy. Thank you so much for joining me on this explainer, and as always, keep learning.